Good morning, everybody. So we've got Andrea Mahati on this week talking about what happened during April, and then we also have Gary Momioni, who's one of the managers of Momentum Multi-Asset Value Trust, talking about that fund. There has been an awful lot of news this week. Well, I suppose it's a relatively short one to start off with. So what I've looked at, I thought it was Weiss Korea, which announced some results. And then I just noticed a couple of announcements about AGMs this morning, and I went back and had a look at some votes we've had recently. So Weiss Korea first. As you can see, it's done pretty well, really, although it's come back over the past year or so in terms of the performance. It's held up very well in terms of its discount, and that's because it's got very stringent discount control mechanisms that allow you to get out asset value, for example, and that's helped a great deal in terms of controlling that. In terms of the performance, it's actually been pretty good. If you just look at this since inception numbers here, so this is the end of April 2022. So relative to the Korea 25/50 net total return index, it's produced numbers that are almost double. More than double, sorry, those sort of returns, and actually it's been holding up relatively recently as well. It dates back to May 2013. It's the only fund we've got that's focused entirely on Korea, and to be fair, we wouldn't expect there to be an awful lot of dedicated country funds looking at that market. It's not just looking at Korean equity, though. It's invested in Korean preference shares, and I'll explain what that means in a second. That benchmark is obviously long now. I put 1040 as this is the 25/50, which is obviously a restricted index because Samsung is such a big chunk of the index. It's 150 million market cap, even after all when it's handed back. As I said, trades very close to asset value, and absolutely also offers you a yield. So, what is a preference share? In South Korea, it's not the same as a UK preference share. Basically, we're talking about there's something more akin to non-voting shares. So they get the same dividends as the normal common shares do. In fact, some of them get a sort of extra top-up payment as well, but they do have limited voting rights. And because they trade at fairly big discounts to the ordinary shares, the common shares, it's a way of buying exposure to Korea, but on much lower PE and much higher yields. So, as I said, we're talking about this because it announced results this week. So, over the course of 2021, it returned minus 1.4% against a benchmark that dropped by 6.1% total return terms. The way that it managed to outperform, and obviously it's a shame it still lost money, but not by much. It buys these preference shares on big discounts and then tries to trade them and capture the discount narrowing. And so the act of doing that added 8.3% to the NAV. And since we started, that's 76% of return. So that this is the alpha, if you like. This is what the manager's added by its actions. Also, as we said before, because these things are high yielding, that adds to your returns as well. So that added 2%. The index wasn't great. Korea fell last year. Quite often, it does manage to outperform the index as well. But actually, its stock selection decisions were detracted in 2021, having added since launch. And then we've got the fees impact down here. So that took off at 1.9%. So the ongoing charges ratio is about 1.8, something like that. Here's a chart that illustrates the outperformance pretty convincingly, I think, and just shows how well it's done and how much of this sort of additional value it's captured for its shareholders. And this is a chart that they stuck in the annual report. It's as at the end of 2021, but really it's just to remind you that Korea is much cheaper market than most of its regional competitors. So the Japanese index, the Taiwanese index, India way up there, we know is quite expensive anyway. US index we know is very expensive. That's one of the reasons it's coming to pressure. But definitely we are talking a market that's actually very cheap. And because of the discount that Weiss Korea is buying its stocks on, it's getting things even cheaper still. So at the end of 2021, the underlying portfolio was on a PE of 6.1. And actually, as of the end of April, that had fallen to 5.0. So that's ridiculously cheap when you think about it. So on average, the discount of the portfolio relative to the common shares was 51%. And so this is what the managers are trying to make money out of by keeping that number relatively high, and then trading out things that narrow and moving into things that will go wider. It's a relatively focused portfolio, about 39 positions, and it doesn't tend to use gearing. So it sort of had some cash on hand at the end of April as well. This is a chart that shows how the portfolio discount has changed, which is the purple line, since it was launched, against the average of the median universe. So what we're seeing here, obviously this is a discount. So the fact that the median universe discount isn't higher than it was means that these discounts have tightened on average. And by trading out of the narrower ones into the wider ones, it's managed to maintain the discount that is on the portfolio. And that's what gives it the sort of opportunity to carry on adding value to the future. This is the portfolio at the end of April. Some of these names would be familiar to you, some of them won't be, but it is a real kind of broad spread of Korean businesses. So Hyundai Motor, LG Chem, which is the second largest manufacturer of batteries for electric vehicles globally. Beauty cosmetics business, Sunwell Pacific. So there's a whole range of different things, including some sort of fairly diverse conglomerate type things, which is common to the Korean market. And Korea, actually, I think is an interesting market. It's, as of 2021, again, this all came from the annual report, it's now the world's 10th largest economy, and that's sort of slowly climbing. Because on the back of 4% GDP growth in 2021, a net income per capita of $35,000 is starting to be quite sort of material too. It's still classed as an emerging market, and I don't know when at some point it would get upgraded. I think it's probably sort of overdue a bit. It's got some inflation problem, but nowhere near as extreme as we have or the Americans have, and rates sort of climbing a bit. So all in all, I think it's actually quite an interesting story. So maybe you want for you to have a look at it if you don't know anything about it. These votes that I talked about earlier, this is really sparked by the top one here. So one of the directors, the senior independent director at Witan, almost 40% of the votes were cast against her re-election at the AGM. Obviously, we were into sort of AGM season now. There's a whole bunch of them happening, so there's lots of examples of these to look at. The reason is that she's been on the board since April 2012, and more investors are saying that you simply can't be on the board for more than 10 years. And so it's interesting that Witan, in the annual report, is sort of implying that they like the continuity of having a director with long experience, and wasn't really implying that they have any intention of her stepping down. So it'd be interesting to see what they do for this. I think with such a big vote cast against, they're going to have to make a statement on the back of this. This is something that we see. Few other ones not quite as significant. There's another one today, one of the non-exec directors of Apex Global Alpha. People voting against that. I can't see a reason why other than he's involved with Jersey Electricity. Maybe it's a vote against them putting their prices up. Honestly, I just can't see why what's happened. Greencoat, which we know is regularly expanding. 10% of votes were voted against it continue to expand. That's a bit strange, especially because they're never going to issue shares at a discount. And so every time they issue shares, it's actually good for existing shareholders. So I find that a bit strange. The Sandy Nairn one, he's the manager of EP Global Opportunities. I would have thought more people would have been objecting to him remaining on the board. It's a long-standing position, but generally I just don't like the idea of having a manager on the board. I think the two things should be completely separate. But still, 9.2% vote against him. And then another director who's been on the board for more than 10 years here, Mark Housen-Chaplin, on Aberdeen, China. He only got 10.7% of votes cast against his re-election, though, because they actually have said that he's planning to go. It's just a question of timing. So I think in the coming months, they're going to recruit a new chairman and do that. All this is quite interesting. It just shows, just reinforcing you the power of voting and the importance of you casting your vote. All of these are percentages of votes cast, not the percentages of available votes. And some of these things, the turnouts are relatively low. So it is important to get out there and vote, as we saw yesterday. Good. That's enough from me. I'm now going to hand you over to Andrew.
That's great. Thank you very much, James. I'll just move over to my screen. Good. I'll forgive you for stealing my joke that the shareholders are revolting, but there we are. It's quite interesting, and I think especially in relation to the ongoing expansion and regular share issuance, which at some point I think during tougher conditions might present more of an issue, because it's clearly highly beneficial for the manager, and I think the incremental value for the shareholders is sometimes quite small. But anyway, we'll see what happens with that. I'm here to talk about the movers over the month as usual. And actually, it was a very difficult month, of course. I mean, equity markets have been weak. The investment trust sector as a whole was down about 5%. So it was quite good, actually, to see a decent number of rises, a few of them in double digits. And I think there is a bit of a theme here, which is mainly energy. Of course, rising power prices are at the forefront of many of our thoughts. And here, I think, we've seen the renewable energy sector very much in demand, partly, I think, because of the rising power prices, and partly as well because, of course, they're seen as quite reliable yield plays at a time when the market is exhibiting more volatility. I'll just highlight a couple before I move on. Premier Mice and Global Renewables was the one I really talked about last month. And it has closed a bit of the discount gap that I was talking about then. The discount was about 18%, which just seemed far too wide. And it's narrowed, it's now 9.6, which is better. But I think that's still one of the only ways you can buy into renewables at a discount. So that could still be of interest. And the one in black there is Gulf Investment Fund. That's not renewable energy, but I think that's seen as a proxy for oil and gas, or oil especially. And so, but it's not a very well-known trust, so I'll just say a few words about that as well. On the fallers, these are more substantial, as we would expect during a difficult month. And some of these, they really are quite significant falls. Again, there's a very definite theme here, which I think is probably very obvious to most of us, which is that it's growth. These are very much growth-oriented trusts. There's a mix of listed equity and gross capital here. I possibly could have classified another couple of these as growth, maybe Smithson and Bellevue Healthcare as well. But I was just trying to pick out the obvious ones. These falls are very chunky and clearly reflect the ongoing rotation from growth to value, which is partly driven by higher interest rates. Obviously, they went up this week, both in the UK and US. But I'll just have a talk about what's happening there and what value there could be. So I'll start with battery storage now. And just to put this into context, and the context being, you know, that anyone who's been looking at the investment trust sector for a long time, I think used to have quite an easy job in hindsight, that you really needed to make geographic decisions. So you were deciding between Japanese equities and North American equities and Europe and the UK. Now you've got this tremendous array of different industries to examine, and they're often quite complex. And I think this has been a bit of a difficulty actually for the battery storage trusts. They're quite hard to understand. And they've been around now for a few years. But part of the difficulty is that their revenue streams are different to one another, and they also shift over time. So just as you think you've got your head around the balancing contracts that make up a big chunk of their revenue, then the National Grid offers a different kind of contract and the whole thing changes again. So I think in terms of understanding the revenue streams, it's quite difficult. It does help though that there are 3 dedicated storage trusts now. So that's Gresham House Energy Storage, Gore Street Energy Storage, and the Harmony Energy Income Fund. So it helps that there's a bit more information being made available. The only thing I would warn against is reading across from one to another, because they do operate in different ways. So just because one has had a great uplift doesn't mean the others are necessarily going to follow at the same time. And I think faced with this great difficulty of really understanding how these companies generate their revenue and how the operational day-to-day work plays out, I think you just have to remember what the underlying argument is actually, which is, to my mind, extremely strong. And it's undeniable that as more renewable energy is fed into the grid, and renewable energy doesn't have an on-off switch, you need to have the storage to balance the load. And therefore, there's an inevitable demand for this. But it's interesting, it's been a very strong performing sector of late. But it has depended which trust you've been in. So the blue line on this chart, this is a 3-month chart. The blue line here is Gresham House, which had a big uplift. It said that its NAV was going to be much higher due to some new auction contracts and various other work it's been doing. The green line is Harmony Energy, which has actually had a really nice start to life since its IPO in November. It's made good, steady progress. And it said again this week, actually, that because of contract renegotiations and revaluation of some of its revenue streams, it expects its next NAV to be 9 pence higher, which is quite significant. The black line here, which is the dull one, is Gore Street, which has been the laggard of late. And to my mind, that's quite interesting because it's just been through a capital raise, which does tend to depress the price for a while because you mop up all the buyers. And the other thing is, it just happens that its reporting schedule is 3 months after Gresham House, and therefore it could be that there's a bit of good news to come, subject to that caveat about reading across. But I'll just mention a couple of other things here. I mean, first of all, just to give you a little breakdown of the kind of revenue streams. This is Gresham House and its revenue generation for 2021. And you can see it's got the dynamic containment contracts are really the most significant part now. And trading now is 12%. but at various times, trading has been more important. It depends on the volatility of the power price. But there are a number of other types of contracts as well. And these seem to shift around quite a lot. There are new contracts being offered on a frequent basis by the national grid. But this data came from the December 31st year end. And I'll just point out that Gore Street's year end is 31st of March. So it's a couple of months to wait now before their annual results come out. It'll be interesting to see what they say about their NAV. My feeling is that it might be quite good news because until recently, the two of them did track each other reasonably closely, actually. And if you looked at the 3-year figures, until this last jump in NAV from Gresham House, Gore Street was slightly ahead. But there's no doubt this is a significant global industry now. This is not just a UK industry. It's not driven by these investment trusts. You can see this figure down the bottom here that $12.9 billion was invested globally into battery storage in the first quarter alone. So it's a very big and growing industry, and I think one which deserves some attention. And moving on to old energy, dirty energy, the Gulf Investment Fund, I think, is considered by some to be a proxy for the oil price. And it's just worth, I thought it was just interesting to have a little dig into it to see what it's all about, because this trust has appeared on the list of risers quite a few times over recent months. And I must say, I didn't know very much about it. So it was really difficult actually to find out what its market cap was. It doesn't get mentioned in the quarterly fact sheet at all, for example. And I had to do quite a lot of digging, but I think it's about $100 million. The shares are on a small premium. So the NAV is $2.23, share price $2.31. It's advised by the Qatar insurance company, so they're the investment advisors, and 40% of the assets are in Qatar, some in Saudi and United Arab Emirates. Interestingly, the portfolio actually doesn't have very much in energy directly at all. It's much more in banking. There's half of it is in financials, some in property, some in industrials. However, really, these are economies that are completely driven by the energy industry. So when oil is doing well, these economies are doing well, and vice versa. And you can see this chart here. Maybe it's a little bit arbitrary that we have the share price of the Gulf Investment Fund in blue, and then the black line is the FTSE 350 oil, gas, and coal index. And you can see that they really move very much in tandem. So I think actually, although the trust itself disputes the fact that it's all about oil, and in their presentation pack, there's a very nice chart showing the correlation between the local stock markets and the oil price is only 35%. But this, I rather beg to differ on the basis of this. So I think it is a proxy for oil. And maybe the FIFA World Cup coming up at the end of the year is going to focus a bit more attention on Qatar, which may be positive, but it may also be negative. We'll wait and see. This trust as well, I think, clearly doesn't have a very high public profile, but Ian Cowie in the Sunday Times is a big fan and has a holding, so it does get a bit of publicity. The final thing to mention, of course, is that because it's partly based on the oil industry and partly because it's investing in the Gulf states, there may be some ESG questions for some investors who might not be comfortable with it. So let's look at the downside now, and growth being so much out of favor. If we were to wind the clock back at maybe just 7 months or so, we were all talking about how value was totally out of favor, and there was this massive gap between value and growth. That's been reversed, and value is very much in demand now, and growth out of favor. There are reasons for that, of course. Rising interest rates mean the duration argument applies, that the future cash flows from growth are worth less in current terms. And I think there are growing worries about recession, and therefore that could undermine the prospects for the growth stocks. It doesn't help that in the US, you've had quite poor news from some of the FANGs, obviously Netflix, from Alphabet, from Meta, from Amazon. They've all been a bit disappointing of late. And so there are good reasons actually for a bit of a sell-off. I found it quite interesting. I mean, the sell-off has been very substantial. And we can see from these two charts here, this is Allianz Technology on the left, Scottish Mortgage on the right. They've both fallen very heavily over the last 6 months. And these are quality trusts, I think, with good managers. I don't think this is reflecting any negativity on the part of the perception of the managers. It's just the underlying markets. And now I'm starting to see that this general distaste for growth has bled into some allied areas like private equity, where we've seen discounts expanding again, in spite again of quality trusts that are currently delivering good returns. So something like HarbourVest Global Private Equity announced its February NAV was up 5.5%, continuing its recent growth. And that was based on only parts of its portfolio being revalued as well, with more to come. So you would imagine that it might well have a further uplift to come in the month ahead. And yet the shares are very much out of favor, going down in value. And there's a 35.6% discount already on an NAV that's currently rising. So I think if you're prepared to take some risks, there are potentially some opportunities. So that leads us to the big question, really. I mean, how on earth do you determine when the moment is right to buy these things? I'm definitely not going to give you any answers to that. But it's not that easy, because you can't base it on yield, you can't base it on PE. You've really got to determine for yourself what might be a fair value, but also when you think sentiment might turn, when these things might be considered oversold. And I don't know when that is. There's quite a big risk of going in too early, because you could have decided that a couple of months ago, actually, and you would have lost quite a lot of your capital since. What I would say now is that from the news that I'm reading, I think the level of pessimism is quite high, and quite a lot of good news is currently being dismissed. So just 3 quick examples. Augmentum FinTech said that the revaluation of its holding in a company called Grover is adding 14.3 pence to its NAV, which is about 10%. It hasn't had any other news on its portfolio valuation, so we don't know what else might have gone down in the interim, and that's the difficulty. But the shares have been weak and really didn't pick up at all in response to that news. Seraphim Space said a while back that one of its holdings, D-Orbit, was planning a SPAC listing this year. I mean, these things take some time, but if that does play out, it'll be a 10-bagger for the trust, and a significant uplift to the NAV. But again, the shares have been very weak recently. And Chrysalis Investments has a massive holding in Klarna, and I was reading that Klarna might well have a new financing round quite soon, actually, and that would likely be at a higher valuation, which could again be very significant for Chrysalis, but the shares again very weak. So a lot of this good news is being ignored, I think, because the underlying sentiment, I think, is flowing so much against these trusts based on the macroeconomic environment. Against that background, I think you would have to be extremely bold to decide that you're going to make a tactical switch, and you're going to put a large lump of capital into these shares at this point. However, I don't think that means you necessarily need to ignore them. For example, if you're getting dividend flows from your portfolio that you're reinvesting, then you could potentially just start to trickle some of that money into these trusts. And And I've long been a great fan of monthly investing. And I think actually if you're doing that, and you're a long-term investor, maybe a younger investor, then you can use a start monthly saving into these trusts, maybe mixing them in with some other more conservative trusts, and you might find that you do well. It's an interesting question. I'm sure we'll be coming back to this quite a bit over the coming months. But there we are. I think that's probably enough excitement at the risky end of the market for now. Thank you very much.
Thanks, Andrew. Thank you. Right, now let's see if we can get everything back again. There we go. Cool.